Hi and welcome to Paper Bag Finance, where everything fits in one paper bag. You will learn financial ratios and financial analysis in just a few minutes. We'll cover some of the most important ratios used in financial analysis and how they can help you understand the financial health of a company. We'll be using Company X as an example to demonstrate how these ratios are calculated and interpreted. Leverage ratios. Leverage ratios measure the amount of debt a company has relative to its assets or equity. High leverage ratios can indicate that a company is taking on a lot of risk, as it is relying heavily on borrowed money to finance its operations. Some common leverage ratios include the debt-to-equity ratio and the debt-to-assets ratio. For example, let's say Company X has $500,000 in total assets and $200,000 in total debt. To calculate the debt-to-assets ratio, we divide the total debt by the total assets. $200,000/$500,000 equals 0.4. This means that 40% of Company X assets are financed with debt. Solvency ratios. Solvency ratios measure a company's ability to meet its long-term financial obligations. These ratios include the interest coverage ratio and the debt-to-equity ratio. A company with strong solvency ratios is generally considered to be financially stable. For example, let's say Company X has $100,000 in net income and $50,000 in annual interest expenses. To calculate the interest coverage ratio, we divide the net income by the annual interest expenses. $100,000/$50,000 equals 2. This means that XYZ company is able to cover its interest expenses 2 times over with its net income. Liquidity ratios. Liquidity ratios measure a company's ability to meet its short-term financial obligations. These ratios include the current ratio and the quick ratio. A company with strong liquidity ratios is able to pay its bills and debts as they come due. For example, let's say Company X has $50,000 in current assets and $40,000 in current liabilities. To calculate the current ratio, we divide the current assets by the current liabilities. $50,000/$40,000 equals 1.25. This means that Company X has $1.25 in current assets for every $1 in current liabilities. Profitability ratios. Profitability ratios measure a company's ability to generate profits. These ratios include the gross profit margin and the net profit margin. A company with strong profitability ratios is generally considered to be financially successful. For example, let's say Company X has $200,000 in total revenue and $100,000 in cost of goods sold. To calculate the gross profit margin, we subtract the cost of goods sold from the total revenue and divide the result by the total revenue. $200,000, $100,000/$200,000 equals 0.5. This means that Company X has a 50% gross profit margin. Activity ratios. Activity ratios measure a company's efficiency in using its assets to generate sales. These ratios include the inventory turnover ratio and the accounts receivable turnover ratio. A company with strong activity ratios is generally considered to be well managed. For example, let's say Company X has $100,000 in average inventory and $500,000 in annual cost of goods sold. To calculate the inventory turnover ratio, we divide the annual cost of goods sold by the average inventory. $500,000/$100,000 equals 5. This means that Company X is able to sell its entire inventory 5 times per year. In conclusion, financial ratios are an important tool in financial analysis that can help you understand the financial health of a company. By looking at leverage, solvency, liquidity, profitability, and activity ratios, you can get a better idea of how a company is performing and whether it is a good investment opportunity. If you have any question or topics to be discussed, please comment down below. Don't forget to like and subscribe. We hope this video has given you a better understanding of these ratios and how to use them in your financial analysis. Thanks for